Well, hello, and welcome to part 3 of our 4-part series, Year-End Tax Planning Ideas for 2020, and we're going to get started right now. I'm John Williams, the owner and advisor at Ironwood Wealth Management. In parts 1 and 2 of this series, I discussed several potential year-end tax planning ideas, and today I'd like to discuss a few more. First off, remember, review your year-end retirement contribution planning. Here are some contribution plan maximums that could be applicable if you are participating in one of these types of plans. Another critical area to review before year-end, because of this new Secure Act, is what we refer to as overall family tax bracket management. Now, logically speaking, if you are in a higher tax bracket than your beneficiaries, then it might make sense to let them take distributions after you pass away in their lower bracket rather than in yours. If your beneficiaries, however, are in a higher tax bracket, then it might make sense to take distributions in your tax bracket before you pass away, and then convert these accounts to Roth IRAs. That will leave your beneficiaries an account that, although must be taken out 10 years after you pass away, it can still grow tax-free for those 10 years. Some benefits of Roth IRA conversions include, well, they could lower your overall taxable income in the long run. Roth IRAs have no required minimum distributions like others do at age 72, and Roth IRAs allow tax-free withdrawals for your beneficiaries. Qualified tuition plans, also named 529 plans, can be a great way to tax efficiently plan for the financial burden of paying tuition for children or grandchildren. Originally, earnings in a 529 plan could be withdrawn tax-free only when used for qualified higher educational expenses at colleges, universities, vocational schools, or other post-secondary schools. However, the rules changed, so now 529 plans can also be used to pay for tuition at an elementary or a secondary, public, private, or religious school, up to $10,000 per year. Unlike IRAs, there are no annual contribution limits for 529 plans. Instead, there is a maximum aggregate or total limit, and that varies by plan. Under federal law, 529 plan balances cannot exceed the expected cost of the beneficiary's qualified higher education expenses, however. 529 plan limits do vary by state, ranging from $235,000 up to $529,000. Some states, like West Virginia, even offer a state tax deduction, and some have a state tax credit up to a certain amount. Keep in mind, contributions to a 529 plan are considered a completed gift for federal tax purposes. So in 2020, up to $15,000 per donor per beneficiary qualifies for the annual gift tax exclusion. Excess contributions above that $15,000 limit have to be reported on IRS Form 709 and will count against the taxpayer's lifetime estate and gift tax exemption, which is currently $11.58 million in 2020. There is also an option to make a larger tax-free 529 plan contribution if the contribution is treated as if it were spread evenly over a 5-year period. Here's an example. A $75,000 lump sum contribution to a 529 plan can be applied as though it were $15,000 per year, as long as no other gifts are made to that same beneficiary over the next 5 years. Grandparents sometimes use this 5-year gift tax averaging as an estate planning strategy. If you want to explore using or setting up a 529 plan, it can be a little confusing, so feel free. Call us and we would be happy to assist you. Thank you for watching part 3 of our 4-part year-end tax planning series. Be sure to tune in to part 4 of our year-end tax planning series for more important information. Oh, and please remember, your health and well-being is a high priority, and we truly appreciate the trust and confidence our clients have placed in us. We'll see you in part 4.